I think when we look back at Canadian M&A in 2011, it was a very interesting year for Canadian companies. We set a record in terms of the total number of deals that took place, with almost 3,200 for the year. And when we look at the overall deal value, it was about 22% higher than it was in the prior year and double what it was in 2009, although still well below the 2007 peak. We also, for the first time ever, saw the value of Canadian companies buying companies in the US actually exceed the dollar value of US companies buying into Canada, which I think was also very significant and a real support for the fact that Canada's had a very strong economy and a very strong base upon which to go onto the global stage and participate in the global M&A market. Canadian PE was also very active on the global stage, and pension funds in particular are actually now being looked at, Canadian pension funds being looked at as a best-in-class example of how they should be structured and how they should be doing direct investing around the world. So a number of kudos for Canadian M&A coming out of 2011. When we look at the sell side, certainly when you look at the domestic market in Canada, not as many participants from outside of Canada, so not as many foreign buyers coming into the Canadian market. A lot of the deal activity was Canadians to Canadians. I think when you look at where multiples have gone to, they've certainly gone back a long way towards where they were around 2007, getting close into the 9.5 times range of multiples, which means that there's been a lot more support for good deal activity in the marketplace. When we look at motivators and drivers for some of the acquisitions or some of the things that will support the sales, certainly as well, the amount of leverage has probably had a bit of a dampening effect on the market, so we're seeing a greater proportion of equity being required to be part of the deal. Well, interestingly, when you look at the industry side of things in Canadian M&A, it shifted in 2011. Most of what we've seen post-2007 has been largely focused on the extractive industries. So we've seen a lot of mining deals, a lot of oil and gas deals, representing more than 50% of the overall level of M&A activity. When we look at 2011, however, we started to see more diversification, and the extractive industries represented closer in line with probably about 35% instead of over 50%. So we saw more transaction activity in the financial services space, as well as in real estate. And I think what's partly driving that is when you look at the alternative investments that are out there in the form of interest, rates are very low, so there's very low yield that's available. And so buyers are really looking for alternative investments that they can have that are going to give them a more secure, long-term, reasonable rate of return. I think that's part of what's driving that.